The next strategy is bear call spread. Before we get into it, let's just quickly look at what if I create a bull spread by way of call. Can I create it by way of a put? Yes, I can, by buying a 40 strike price put and selling a 50 strike price put. I think this is something that we will discuss in the subsequent slide. Let's look at what a bear call spread is. A bear call spread is the sale of a bull call spread. So what I do is, sticking to the same example, I bought a 40 call and I sold a 50 call. That was a bull spread. If I buy a 50 call and I sell a 40 call, that means essentially the other party. So if you bought 40 and you sold 50 to the other party must have bought 50 and sold 40. So the position of the other party is termed as the bear call spread, right? So it's buying a 50 call and it's selling a 40 call. So clearly there will be a net premium inflow as far as this strategy is concerned, and the underlying view being, when I create a bear call spread, the underlying view being that the stock will not rise, rather it will fall. And hence, both the options would be out of the money and I will take home the premium that I pocketed, right? So the bear spread trader will purchase the call with the higher exercise price and sell the call with the low exercise price. This strategy is designed to profit from falling stock prices. When the stock prices falls, well, both the calls, the one which you bought and the one which you wrote, both would be out of money, thereby allowing you to take home the premium that you received from it. So out here, the upside will be to the extent of the premium, and the downside will be to the extent of the losses, the negative payoffs on this option, which is minus 10. And let's say you receive the net premium of $3. So you would say, well, your maximum loss could be to the extent of $7. So how do I replicate a bull and a bear spread using puts? Yes, I can. Let's take our example, and I believe this is what I was trying to discuss in previous slide. To a limited extent, I started off with that. You would say I could create a bull spread by going long call 40, going short call 50, or by going long 40 put and by going short 50 put. Then you would say, so what's the difference between the two? The difference being that here net you pay a premium to begin with, and here net you receive a premium to begin with. That's the difference. So here you receive a premium, here you pay a premium. And similarly, a bear spread as well can be arrived at by way of puts, by buying a 50 put and selling a 40 put, or by buying a 50 call and selling a 40 call. There we have it, same points being indicated. You can easily draw the payoffs, right? So let's take an example. An investor sells a put for 3 with a strike price of 20 and purchases a put for 4.5 with a strike price of 40. Compute the payoff of a bear put spread strategy when the price of the stock finally ends up at 35. Now look at this. I sold a put for 3 with the strike price of 20, and I bought a put for 4.5 with the strike price being 40, right? So I'm long this particular put. So I bought a 40 put and I sold a 20 put. Okay. Now I need to find out the payoff of this strategy when the price of the stock finally settles at 35. If the stock finally settles at 35, this put would give you 5 and this put would be worthless, thereby allowing you to make a payoff of 5. Now the premium that you had paid net for this is $1.5 because you receive 4.5, and you paid 3, right? You would say your net profit will be 3. There we have it.